Hello, this is Steve Sanangelo once again from the SRS Rock Report, and I'm glad that you're joining me today because I'm going to discuss why I believe gold and silver won't crash along with the stock markets. Now, I've discussed this and I've mentioned this several times. Unfortunately, I continue to get emails as I see people writing that they believe gold and silver are going to crash with the markets or fall with the markets. And I've got some pretty interesting data and charts to show why I don't agree with that. I also have included the most updated information on the break-even analysis of the gold and silver miners, which is, to me, a floor in the price. So let's get started with the first chart. This is a 20-year chart of the gold price. It's currently trading at $1,318. According to my analysis, its estimated break-even is $1,205. So the current gold valuation is about 9.4, 9.5% above break even. Now, the MACD, I've shown the MACD, which is a technical analysis indicator, and that gives an idea how oversold, overbought, or oversold a stock or commodity is. Now, in 2008, like the markets, gold price shot up and sold off, and it went up again in 2011. And as we can see, it really fell, and it was oversold in 2014 and 15 and 16. Now, right now, gold is a little bit above its baseline. To get the break-even analysis, I looked at Barrick, Newmont, and Goldcorp. And this is the most recent analysis, Q1 2018. I go by their adjusted income. That's my break-even analysis, their adjusted income approach. I could go by the capital expenditures, but I do not like the cash costs or all-in sustaining costs. They don't include all costs. Now, Barrick made $1.79 billion in the first quarter, 170 million in adjusted income, so its profit was 9.5%. Its estimated break-even was $12.05. Newmont did a little bit better. It made 1.81 billion. It had 185 million in adjusted income. Its profit was 10%. Now, its estimated break-even was a little bit lower. It was 1,193. And Goldcorp, that doesn't produce as much gold as Barrick and Newmont. They made 846 million in revenues. They had a $67 million adjusted profit, and so they had 8% profit. So their break even is a little higher at 1227. If we do a weighted average of these, it comes up to be 1204, 1205. So in the first quarter, the companies were making about $125 profit per ounce. Now, silver is a little bit different. Silver, its current price is $16.49. Its estimated break even for the group I used was $16.18. So its current valuation is only 2% above break even. And we had the same thing with gold. We see it moved up silver at the MACD in 2008 with the markets, sold off, moved back up in 2011, extremely high, the spike to 50. And then it sold off. And as we can see here, as the price of silver fell, the MACD is well below the baseline. 2015 and 16. Now, differently than gold, gold was above the baseline, but silver is still below it. So to me, silver is closer to its low even than gold. And I'll show you the break-even analysis. I used Pan American Silver, Coeur d'Alene, Hecla, and First Majestic. There is also Fresnillo, which is a larger primary silver miner, but more of their revenue now comes from gold. And I wanted to focus on these four. It's a pretty good indication of what's going on in the market. And they did not yet come out with their 2018 results first quarter. So this is 2017. Pan America produced like 24 million ounces last year. Their estimated break even was 1545. Core was 1686. Hecla 1585, and First Majestic actually suffered a 6.2 million adjusted income loss last year. So they had a loss of 2.4%. So that their break even was higher than spot. What they received, it was 17.53. So if we do a weighted analysis, it's $16.18. Basically, the group made an 87-cent profit. The primary silver miners aren't making as much money. Their cost of production is closer to the spot price than gold. I think the silver price is undervalued to gold. Now, if we are going to compare gold and silver to the S&P 500, we can see a much different setup as I've shown before. Now, going by the S&P price to earnings, the average price to earnings for over the last several decades, it's 62% overvalued. The S&P is, and currently it's at 2,668. A 62% overvaluation means the current fair value for the S&P is 1,120. That's about right here. Now, if you look at the MACD, like gold and silver, it moved up, then it sold off, and then it moved up, had a little sell-off here, and we're well above the MACD peak going back to 2000. The S&P 500 is extremely overvalued. I show it being about 1,100 plus. Its 200-month moving average is 14. There's a long way to go. Now, what's interesting, the S&P 500 and the Dow Jones Index are similar. It's almost the same chart pattern. I did the exact same thing, 62% overvalued. Currently, the Dow Jones is 24,315. Its fair value is 11,700. That's about right here. The 200-month moving average is 1322. And just like with the S&P, the MACD moved up in 2008, sold off. It had the same MACD line as the S&P. It's extremely overvalued. And if we compare, go and looking at the silver chart once again, silver is not overvalued. Silver did correct in 2008, fell from 20 down to 9. MACD sold off. But we had a huge move up and we had the huge sell-off. And looking at the MACD for silver and also the break even, silver is so close to its low, even compared to gold, compared to the markets. This to me is the undervalued asset. Now I wanted to look at a few of the large retailers and stocks. Walmart is the largest retailer in the United States. Its stock price is overvalued, but Walmart is still a good company. Right now, its stock price is 87. Walmart's PE ratio is 27. Its average for the last decades is 14, so it's 48% overvalued. That means its fair value is $45, which is about right here. Its 200-month moving average is 51. Even though Walmart is overvalued, they employ 2.3 million people. If you own Walmart shares stock, they pay you a $2.04 dividend. Last year, they paid out $6.1 billion in dividends. As we can see, the MACD is very high here. Now, if we compare it to the largest online retailer, Amazon, we see a totally different stock, a totally different setup, totally different valuation. This price chart of Amazon resembles the exponential curve. It's currently trading at $1,572. Its stock PE ratio is 256. The average for its industry is 42. It's 84%. And this is being conservative. It's 84% overvalued. That means its fair price is 252. What's fascinating, if we look at the 200-month moving average, it's 257. So its fair value is very close to its 200-month moving average. Look at the MACD, it's gone straight up. It's higher than anything. Now, even though Amazon has got a great stock price, it is making money. Amazon's making money. They're making good free cash flow now. They pay no dividend. They pay no dividend. Amazon, Walmart paid $6.1 billion. It's sharing the profits with its shareholders. Amazon is not. The reason why Amazon isn't is because, first of all, a 1% yield would be like a $15 a share compared to Walmart's 2. They would have to pay such a small yield, it almost isn't worth it. So the only place a shareholder gets the value is in its huge increase in its share price. But what happens when it falls? At least when Walmart falls, let's go back to Walmart. Even if Walmart falls, you're still getting paid a dividend. Amazon is paying no dividend. It employs less than a quarter of what Walmart employs. But let's take a look at the interesting stock, Netflix. Netflix's share price is very similar to Amazon. It's gone up exponentially. Look at these shooting stars here. This is not a good sign for Netflix. Its current stock price is 311. Its PE ratio, price to earnings, is 209. The industry average is 20. I looked at Time Warner. They are another content provider for the TV, the networks. Their PE ratio is 14, and they're making money. Netflix is 90% overvalued, which means a fair value for its stock is about 31. They don't even have a 200-month moving average. Again, we can see the MACD has really shot up. Netflix pays no dividend, and they only employ 5,500 people. So I just wanted to give you a little bit more information, just how overvalued these stocks are, even the indexes, how high the MACD is. This means something is overvalued. Getting back to gold, just to show you, even though gold is 9.4% above its break even, its MACD is close to its baseline. Gold and silver are going to be the places where the investors will move to protect wealth. Now, I wanted to show this next chart. And the reason why I don't see the price of gold falling much from here has to do with the information in this chart. I know Harry Dent, there may be a few others, they're predicting gold is going to go down to 750, 800. That's right, that's here. That's right around here. If you look at the chart, you'll never see, this is Barrick and Newmont's production cost in orange. The market price of gold is in the dollar bars. You'll never see the market price below Newmont and Barrick's cost of production. Now, at the peak in 2012, they had the most profit margin right here. These two companies, their cost of production was $1,272. The average price of gold that year was $1,669. They almost had a $400 profit margin. As the gold price sold off, we also see a decline in the cost of production, but not as much. And at the bottom in 2015, cost fell to $1,109 along with the oil price, and then the market price was $1,160. There was still about a $50 profit, but it wasn't as much as it was here. Now, as you notice, as the price of gold has moved back higher, so has the costs, and this is due to oil going up as well. But the margins are about the same. So in 2018, it's about $1,200, and this is not including Goldcorp. And the gold price in the first quarter of 2018 was $1,329. So even if the gold price was to fall, I don't see it falling below its cost of production. The cost of production could fall a little bit if the oil price falls, but to get down to 800 or 750 or even 1,000, it never got down to 1,000. So to me, when the markets start to really correct and crash, I don't see the gold price falling. Maybe initially gold and silver could fall somewhat, but in the second stage of the crash, gold and silver price will head higher. Now, I wanted to show some more interesting data here. This is the world gold mine production, 2007 to 2017. Production bottomed in 2008, increased substantially. And in 2006, it was 104 million ounces. Now, I don't know if this is the peak. It is the peak in this chart. We could see higher production maybe in a few years, but it's been plateauing. It hasn't been moving up as much as it was before. So gold production fell slightly to 103 million ounces last year. Now compare it to silver. World silver mine production, according to the data in this chart, peaked at 895 million ounces, is now at 852 last year. Part of the reason there's a few large silver mines that shut down. And I don't know if one of those mines will ever get back into production. That's going to be interesting to find out if that's going to happen. Anyhow, it's down about 5%. Now, what's interesting about gold and silver, when the markets start to correct and we see investors move into the precious metals, the production is starting to peak right at the time when demand is going to increase. So I wanted to conclude back again, which is one of my favorite assets is silver. To me, it's the underdog. Silver is only 2% above its break even compared to gold, which is 9.4%. Its MACD is below its baseline. It has sold off considerably. I don't see much downside. I do not see it going back to $8 like in 2008, because we have to remember the oil price reached $140 in 2008, sold down to $30. The price has only doubled now. The price of oil has doubled to about $65. Right here, the price was $8.9, it's now $16. Because the oil price is so high, we're not going to see silver. Now, if oil price fell, we could see the price of silver fall, but we have to remember there aren't many assets. Silver wasn't up here with oil. Silver is down here. There aren't many assets to protect wealth in the future. To me, gold and silver are a few of the assets that will do that. Again, I wanted to show the Dow Jones one more time. It's very overvalued, at least 62% overvalued. I've heard some analysts say it's going to fall down to back down to this line here, which is 7,000. Either way, this is not a place to be. I'm not saying the Dow Jones can't continue to go up a little bit from here, but this is extremely overvalued. The baseline for the MACD is right here. When it got to its low here, it fell down to 6,600. So these are overvalued assets. The indexes, the stocks I've showed you, not gold and silver. So in conclusion, looking at the break-even analysis for gold and silver, looking at the MACD levels, I don't believe gold and silver are going to fall much during the next market correction. Matter of fact, I think we're going to see huge increases in demand and price. And again, this is not going to happen next week, next month. It's something I see taking place over the next year or two. Well, thank you once again for joining the SRS Rock Report, my newest update. And if you haven't, please consider subscribing to the SRS Rock Report YouTube channel. And once again, you have a great day. Thank you.